Hello everyone. Welcome to the Road to El Dorado. Here we help ordinary people achieve extraordinary financial success through simple and smart decisions. If you've ever felt like investing is too complicated, too risky, or simply not for you, then this video might just change your mind. Today, I'm going to show you what I believe is the easiest investment in the world and why it's the perfect way for you to start building wealth even if you are a novice to investing and don't have a lot of capital to work with. Let's dive in. You've probably heard people saying, just invest in the markets. But what does that really even mean? Most of the times, they are referring to the S&P 500. The S&P 500 is what is known as a financial index. You can imagine it as a basket full of shares of big companies in the US. To be precise, the S&P 500 is a combination of stocks of the top 500 companies in the United States. We are talking about companies such as Apple, Microsoft, Facebook, Tesla, and so on. When you are investing in the S&P 500, you are not picking individual stocks, but instead you are investing in all of them automatically. The reason why this is important is because if you look at the price of S&P, since it was created up until today, you would discover that its price has always been on a general uptrend. It has its ups and downs, of course, but what is interesting about the price is that every time it does a drop, the price eventually recovers and makes a higher high. The price keeps on increasing over time, reaching new, higher and higher highs. Now let me explain why this investment is so simple. You are not trying to guess which stock is going to go up. You are not glued to the screens looking at charts for the entire day. You are not trading every day or reacting to market news. All that you do is investing in one simple thing, the S&P 500, and you do this consistently. You don't need a financial degree for this investment. You don't need to be rich. All that you need is to have a long-term mindset, be patient, and have the willingness to stick to the plan. There are ways for you to even automate this investment so that every month on a specific date, a specific portion of your funds is automatically invested in the S&P. You need to set this up only one time and then you just let it be. You live your life and let the market do the heavy lifting for you. This is the beauty of this investment and why I personally believe that this is the easiest investment in the world. Before we dive into specific S&P 500 examples, let's first check a couple of very important concepts that make this approach work so well and so easy. Those two concepts are the compounding effect and the dollar cost average. Let's start with compounding. Compounding is one of the most powerful forces in finance. Compounding is when your money is earning returns, but then those returns are also earning returns. For you to understand it better, I will give you an example on the screen. So that you can better understand the example of how the compounding effect works, we are going to use a Word file so that we can visualize the numbers and the calculator so that you can understand how the math works over here. Now let's say that in our example we're having an initial capital of $1,000 and we're having an average yearly return of 10%. So what does that mean? In the first year, assuming that you're going to make 10% return on top of the $1,000. Here's how you calculate it. You type in the investment. And then looking at 10% return, we need to multiply it by 1.1. This equals $1,100. So, in other words, after the first year, the profit we would accumulate, assuming we're generating 10% return on top of 1,000, would be this $100. Total portfolio size would be $1,100. Or, in other words, the return for this year would be $100. Now, here is how the compounding effect actually works. So, on the second year, if we assume that you have to make again a 10% return, this time it would be 10% return on top of your initial capital and the profits that you've made so far. In other words, 10% return on top of this 1,100. So, pressing the equals button one more time, we can see that this is taking us to $1,210. For this specific year, the return would be $110. So, not only that we are generating a profit on top of the 1,100, but this profit per year is also bigger compared to the one from the previous year. Now, as you can probably realize, this effect is stacking up the further we go in time. On the third year, our result, our return of 10%, would be based on the 1,210 total portfolio size we had after the second year. So, this is taking us up to $1,331. This is a return for the third year of $121. Now, the further we go in time, not only that this effect keeps on reapplying, but it actually accelerates. The compounding effect is leading to an exponential growth. Let's see what the result would be after 10 years. So far we're on year 3. At year 4, we get to 1,464. Year 5, 1,610. Year 6, 1,771. Year 7, year 8, year 9. Notice we are already at $2,357. We go 1 year further ahead in time and we are at $2,593. This is approximately $250 profit on the 10th year, which is 2.5 times bigger compared to the profit that was generated on the first year. So adding it all up, usually you would think that if you are making a 10% return per year, for 10 years you should be making 10% times 10, which is 100%. On $1,000 we should have made another $1,000 as a profit. But because of how the compounding effect works and the fact that you are making returns on top of your returns, the total result is actually bigger. After 10 years, with 10% average yearly return, we're sitting at nearly $2,600, which is about 1,600 profit, or about 160% return. Next, let us talk about the dollar cost average, also known as DCA. The DCA is a simple but powerful strategy. The idea of it is to invest the same amount of money regularly, regardless of what the market is doing. For example, instead of trying to guess when the market would be at its lowest and when at its highest, you simply keep on investing a fixed amount of money every month. This can be 100, 200, $500, or whatever works best for you. Some months the market might be high and some months the market might be low. By investing the same amount of money every time, you will buy more shares when prices are low and fewer shares when prices are high. Over time, this will allow you to average out the cost of your investments. So why is the dollar cost average so important? First of all, it reduces the risk of timing the markets. Trying to buy it when the market is at its lowest and sell it when the market is at its highest is extremely difficult. When using the dollar cost average, you don't need to worry about this. You simply do your regular investments and over time the market will do its thing. Second, the DCA helps you to smooth out volatility. The market can fluctuate a lot in the short term, but by investing over time, you are avoiding the stress of trying to buy at the perfect time. You are investing in a way that averages your cost, which helps you reduce the impact of the short-term ups and downs. And third, the dollar cost average keeps you disciplined. Instead of reacting to market noise, you stick to a steady plan. This consistency helps you to stay on track even when the market is volatile. Now let's bring those two concepts together with the S&P 500. Before we jump onto an example, what you need to know is that for the last 20 years, the S&P 500 has been managing a yearly average return of 11.8%. This is very impressive because it shows that over time the market tends to increase in value even though there are occasional dips. Let's now jump to the screen and run some numbers. For the example we're about to do, we're going to use the investor.gov website. Once you go on the home page, you can scroll down here to where it says Financial Tools and Calculators, and below Calculators you can select the one that says Compound Interest Calculator. Now, this calculator is extremely useful for calculating the long-term compounding results of investments. So, let's go ahead and do that. On initial investment, we can set $100. And let's say that we're using the dollar cost average, so our monthly contributions remain of the same amount, $100 per month. Now, the length of this investment in years, for the time, we are going to set at 10 years. On estimated interest rate, we are going to put the average return of the S&P 500 for the last 20 years, which is approximately 11.8%. Then down over here on step 4 where it says compounded, we can set whether we want to implement a compounding effect. Considering that we are looking at 11.8% yearly return, we leave the compounding frequency on annually. And then we calculate it. Now, what we can notice is that our total contribution, in other words, total investment is $12,100. But for this period of 10 years, our investment has grown to $21,000. This is a bit over 80% return, which is very good for 10 years, but as time goes further, the compounding effect can accelerate and the results can become even more drastic. Let's see what the results would be after 30 years. So, as we calculate this, we can now discover that a total investment of $36,100 has now turned into $280 return. While for 10 years, the dollar cost average approach on the S&P, together with the compounding effect, has managed to generate for us only about 80%, after 30 years, the total gain is roughly 700% on top of the initial investment. $36,000 total investment would be worth over $280,000 after 30 years with the average S&P 500 return. Now let us see what would happen if we increase the average monthly investment as well. Let's say we go to $200 per month. If that is the case, then we would have invested a total of about $72,100 for this period of 30 years, which after 30 years would be worth a staggering $560,000. Again, about 700% return. So let's ask the big question now. Can we become millionaires with this investment approach, and what would it take? Let's look at the screen again. As you can probably understand by now, this investment can be very profitable over time. If we are to chase a higher return, there are two variables with which we can play. One is the average monthly investment, and the other one is time. On the investment, let us stick to something reasonable that most people can afford to do, assuming they're having an average income and they have some good financial habits and know how to save some money for investments. So let's stick to $300 initial investment and $300 monthly contributions. Then let's see what would be the result if we look at a period of 35 years, and then we still leave the 11.8% average yearly return from the S&P 500. Here's what the result would be. The total investment for these 35 years would be $126,300. It may seem like a lot, but if you think about it, most of you would be paying off your mortgage for a period of 35 years, and very often that mortgage is going to be worth more than $126,000. Now, if we look at the result, however, we discover that after 35 years, this $126,000 investment can turn into nearly $1.5 million. This is a total return of about 1,100% on top of your personal investment. To summarize it, whether you can become a millionaire with this investment, yes, you can do that. It can be easy. It can be done with small monthly contributions, but it's going to take time and patience. Let's quickly cover a few common mistakes that some people do when starting out. The first mistake is trying to time the market. Don't try guessing the highs and the lows of the price. Simply invest regularly. The second mistake is not starting early enough. The earlier that you start, the more time your investment will have for growing. The third mistake is quitting when there is a bigger market pullback. A drop in the price of the market can actually be a good opportunity to buy more shares at a cheaper price. Stick to your plan, stay consistent, and trust the process. So, how do you get started with all of this? You don't need to buy 500 individual stocks. Instead, you can invest into an ETF, which is a fund that tracks the performance of S&P 500. Some popular options are VOO from Vanguard, SPY from SPDR, and IVV from iShares. You can open an account on platforms such as Vanguard, Fidelity, Robinhood, and many others, set up a monthly contribution, and you'll be on your way. So let's wrap it up. But before we do, if you've enjoyed this video and you find it useful, you can subscribe to our channel so that you don't miss out on our future videos. We appreciate it. To summarize it, the S&P 500 is an asset that has proven itself as consistently profitable over a long period of time. The compounding effect allows you to generate profits with an accelerating pace over time. The dollar cost average allows you to invest consistently no matter what is happening on the market. You can start this investment anytime with any capital, no matter if it's small or big. This strategy is suitable for everybody and it allows you to start building wealth over time.